Why do you think this is the right time for you to go for the IPO?
Nothing better than starting at the bottom of a cycle.
We live in the VUCA world. What are those risks that you are sort of, also warning your investors about?
Lending is all about not making the risk zero, but optimizing risk.
We see NBFC MFIs translating into small finance bank, SFBs into universal banks.
The form does not matter.
2025 saw about 8 record BFSI IPOs. We are in February 2026, and the microlender iFinance is going to hit the bourses. Today, we're joined by Mr. Sanjay Sharma, Managing Director, and Mr. Sovan Satyaprakash, the CFO, for this conversation today. Welcome to etbfsi.com.
Thank you.
Thanks very much for your time. First question, you're not a tech-driven platform. You're also not a big bank backed NBFC, a unique, NBFC offering to the MSME space. Why do you think this is the right time for you to go for the IPO?
Sure. Just let me take a minute to tell you about what exactly do we target. The segment that we look at primarily is the micro scale businesses, and we could be either into manufacturing, let's say someone manufacturing shoes in Agra. It could be a trading unit, which could be a small shop, cloth merchant somewhere, or a kirana store, or it could be in service sector in enterprises like a small restaurant or a small tailoring shop, etc. Also, we do dairy businesses. So, focus is on businesses that constitute the core of business in tier 2 and tier 3 towns, and give them funding which is meant for their business working capital or for expansion or for machinery. We have seen a very good track of growth and profitability across the 12 years that we have been operating. And today we have given loans to more than 10 lakh micro scale businesses. Active base is almost close to 6 lakhs. And I think this is a great time to therefore come to an IPO because for us, funds or money is the raw material that the NBFC operates on. The raise of 710 crores that we're talking of as primary will, along with the accruals of this year and the coming years, will allow us to grow our book from currently, which is at 6,000, as of September, to 6,100 crores, to almost close to 15,000 crores. So it will take care of our need for the next 2 years. So obviously a great time to be there, and we're coming on the back of that great cycle in the industry itself. So I believe that that's a great time to get into an IPO where the chances of upside are high.
Noted your points on the capital deployment and where this is going to lead iFinance to. Another question that comes after a company goes public is the governance and accountability. So, what changes for you? What is the entire framework going to look like? What are the compliance mechanisms that are in place as soon as you go public?
I think it's a great question. Many times people don't talk of compliance and governance, and it is the bedrock on which a good NBFC or a good lending institution should be based on. At iFinance, we have shown that effort in making good compliance. One is that we have always used the best of auditors. Statutory auditors used to be the Big Four, and then more recently it is an Indian company which is highly rated among the Indian auditors. We also have a very strong set of independent directors, of which 2 of them are women. So we have also made sure that there are women on our board, they are independent directors, and they are all professional. So there is no linkage to the management or executive team with the board. That is another way of keeping check on good compliances. So we take a lot of pride in ensuring that compliances are good. Every time the regulator has audited us, they have not found any material problems. So we have made that effort, and once we are a public company, the focus of the public media, public eyes, makes it even more important to make sure that compliance stays good and top notch. That's something that as a management team we are fully committed to.
Sure. On that note, it brings me to the risks that are going to be there follow through. I mean, we live in the VUCA world. Uncertainty is something that's been synonymous with everything that we go about. What are those risks that you are sort of, also warning your investors about, and you're very clear handling going forward?
Um, you're very right. It is a VUCA world, and one has to be able to negotiate it. Uh, Lending is all about not zero, making the risk zero, but optimizing risk. So when we look at specific to our segment of customers, one is that this segment has often not been lent to. Many of them are new to credit, and lending to them is very difficult because how do you underwrite a customer who doesn't have the typical bank statement where business transactions are visible or balance sheet and profit and loss account? One is that because the customer has not seen too much of lending or over lending, it's a safer customer to look at. But there could be problems on the fee, and you could see fee fraud. So our approach, which is a digital approach, which means that while we have tremendous amount of good technology, good AI models, machine learning models to help the business, but we still want to have a branch network so that we can verify, right? So I think it's very important to verify what we are looking at and look at actually observed data points to underwrite. And that's exactly where our cluster-based underwriting model is, that we look at what are the key markers of a business. If it's a shoe manufacturing that I talked about, we'll look at how many people are working there, what sort of machinery do they have, throughput of machinery, and then take a call rather than go by paper document. If someone tells me that, I have 20 people, I will not accept that unless I've seen it. So having a brand network helps us in that. And in a VUCA world, I think if you can kill that biggest problem, which for us is the operating related risk, then you are well off. We're very fortunate that the customer we are talking about, the micro scale businesses, have been in operating for many years. These are people who have been running the business for 5 years, 10 years. So they're not very susceptible to close shop and run away. So their intent to pay is very high, and it's very important that we lend them the right amount, and we don't lend it to someone who's obviously not the right customer to lend.
Sure. Also, on the price ban and the valuation, how do you justify that, and how satisfied are you about it?
I believe that the price band is quite attractive, and we have been governed by our bankers in putting that price. We have raised in the past money from private equity at much better price points. So for a change, we are coming into public market and offering a much better ratio, whether you look at price to book or price to earning, whatever. And I'm happy about that because we are starting a relationship with a new set of investors, and I want to start on the positive note. And that's the reason when you ask me that why now, I think nothing better than starting at the bottom of a cycle so that there is positive news as we go along. And I think pricing also, we have kept it at a point where I think compared to market or comparable benchmarks in financial industry, we are quite attractive.
Sure, I'll shift a little gears here and talk about peers in the same space. We saw stress with them. 12 years of operations for iFinance. What has kept you afloat? What has been the driving force throughout? What are those core strengths of your business that today you're hitting the markets?
Uh, I think we have a lot of areas that we would say are important to how we operate. Underwriting is the first piece where we underwrite a customer. Again, we don't have documents, so we don't rely on only documentary data. We can extract bank statements through the account aggregator. So we have all the technology that is necessary to pull information after the customer gives consent. And yet we look at what is observed, which I mentioned about, that physically we need to observe. That underwriting is very solid and it has worked well for us, helped us not overlend to the customer and to lend to the right customer. The second big marker there is the extensive use of technology to and data science models to look at early warning signs, look at possible patterns that show a fraudulent behavior, etc. And finally, I would say that we source all this business through our own team. We don't use a DSA, nor do we use a third party. That ensures that the quality of business sourcing is good. customer service is right at the top of our priority, and we don't see surprises. I think these are three very big markers of why the business is stable. We have also done a lot of good work around our people. We are ranked as a great place to work. We are in the top 10 ranks consistently for many years. And it's a service business, so people have to be engaged, people have to be happy. And many of our leaders, like Sovan, has been there for many years. I think Sovan has been there for 10 years. It's a 12-year-old company with people like him who have spent 10 or 11 years. Almost 10 years. So I think that is a huge strength for the company.
On that note, what are your growth targets going forward? What is the kind of AUM you want to reach? What are the growth and profitability numbers you want to hit? I'm sure capex planning has been into picture of what changes for you as soon as you go public. But what are the numbers on your mind for a longer term period?
So, FY24 was a good year for the overall industry, and we grew more than 50% in that financial year. Post that, for the last 18 months, it has been a difficult period for the overall industry, but still we have maintained a growth rate in the range between 20 to 25%. If things improve, that should be what the trend with respect to growth should be. And obviously, we are starting off at a larger scale compared to what we had in the beginning of FY24. From a profitability standpoint, also, the last 2 years kind of show where the guidance can be. FY24, again, a good year. We delivered almost 4.3% return on total assets with almost 17% return on equity. Post that, the next year, which was one of the difficult years, the return on assets dropped down to almost 3%, return on equity at around 12%. So that kind of sets a benchmark with respect to when a good year return levels can be and what a difficult year return levels can be. Obviously, comparing the last 2 years, many of the metrics have improved further. Cost of borrowing has come down, OPEX has come down. Those is going to aid, those point can further aid to the profitability levels in the year ahead.
Any projections for us for the years to come?
Uh, we are not allowed to speak of projection. I would love to have talked about it. But I think let me just mention that our focus for the coming year is going to stay on the micro enterprise borrowers. And it's a very large segment. The government estimates are that there's a 140 trillion rupee demand, of which only 35 trillion rupee is being met. So there's almost 116 trillion rupee gap. We are fortunate that we have figured out a way to underwrite this segment through the cluster-based approach that I talked about. And this will remain our area of focus. It gives us tremendous scope for growth. We don't want to be over greedy and grow at a very fast pace. Last 3 years, we have shown a CAGR growth of 43%, but now the AUM is bigger. So the growth will naturally moderate down. Last year, we grew at 25%. This year, we should be in that range or slightly more, but it will stay in that range. But we have a long runway ahead of us where we can address the customer need because there's so much to be done. Out of the 7 crore such enterprises, we have only touched 6 lakh as our active customers. So, large target market need to grow is there. There's no need to hurry.
I was going to come on the customer base itself. Are you targeting any sort of customer base going forward? First on the customer base.
So, I think on the customer, we'll continue to focus only on the same segment that we have focused so far. It will be the micro enterprise player into manufacturing, trading, service, or dairy. And we will try to address their needs better or get a better share of wallet for the customer. So, we started with hypothecation loan, which was meant for working capital. We have moved to mortgage loans, which can also address their needs for larger ticket spending, like buying machinery or opening a new unit. Uh, this helps us in covering their business needs. We also have other needs, like sometimes they buy a commercial vehicle or they buy a two-wheeler, etc. These are opportunities which we won't open up immediately, but these are in future we could look at moving in those directions. So answer is that we'll stay focused on the same customer segment, but try to fulfill their multiple needs so that our share of wallet improves.
On that note, technology, artificial intelligence, however, I finance reaching, the customers in the hinterland, providing them with the working capital. How do these three pieces come together? Tech, AI, while reaching the customers that have no sort of connection with all this, and on that note, what is the kind of expense do you have in terms of technology? If you could.
I'll leave the expense to Sohan, but let me talk of technology. That technology is a very important component in the delivery of our services, because when you have a ticket size which is only 1.5 lakhs average ticket size, if you don't have technology, there's no way you can deliver this service at a good price point. So we use technology extensively, especially in the back office area. We use a lot of machine learning and AI models. We have an in-house data science team. For us, NBFC of our size, it's very unusual to have a in-house data science team, and I think we are fortunate that Google Capital is one of the investors, so they have mentored our team in data science, and we've been using it for the last 6-7 years now. Many of these have helped us automate a lot of our underwriting. Today, a straight-through processing of underwriting, almost 35%, one-third of our underwriting happens through machine learning models, which have been tested over 4 or 5 years. So technology plays an extremely important role in bringing the cost down. And I think I can keep talking about that because we use good technology in origination, we use good technology in servicing or repeat loans, and we also use the same technology and data science models in collection, which makes us very efficient in collection. On the cost, there's own add to that.
So in the business model, we completely rely on own employees to source business and collect most of the portfolio. So in the total operational expense that we have, almost 70 to 80% is comprising of people-related cost, and it's a service business at the end of the day. So people costs are going to be a majority part of the expense. So we have been quite prudent with respect to the rest of the expense profile that we had. At an overall level, our technology cost should be in the range of between 5% to about 10% at best in the total expense range.
All right, quickly on the cost of funds, we see NBFCs complaining a lot about cost of funds not being optimal. We speak to bankers; they are a bit averse on lending to NBFCs. How have you sort of navigated this path in terms of funding? What does the mix look like between bank lending, securitization, so forth?
So we don't rely completely on banking, and we have focused on diversifying even the liability side of things. Today, roughly around 30% comes from banks, about 20% from development financial institutions, and mostly based out of India. And the rest would come from NBFCs, PTCs, that even retail investors would invest in through our bonds. That's the typical mix that we have. The focus is on increasing the bank percentage, and we have seen that grow over the last couple of years, but we have never really faced a challenge with respect to debt, primarily because of the diversification strategy that we have followed. So in times when one source can squeeze down on the debt, the other source are available for ensuring that the flow of funds never becomes a challenge for us.
I think there I would add that we've always followed approach that ensuring liquidity is the first goal, and then making it efficient is the second goal. So first thing is diversify so that your liquidity is always assured, and then start looking at how to make the efficiency. So obviously the best, most efficient source of borrowing is from banks, and we are gradually moving our percentage. We are today at 30%. I think a year back we were at about 20-22%. We gradually grow it because now we have a diversified pool. Now we want efficiency, and what we saw as borrowing at 11.3% last year, today in the first half, if I look at till September, our incremental loans are coming at 10.6%. So clearly we can see that the move is to, now that you're diversified enough, you want to bring it efficient.
Noted. That will be my last question now. What's the vision for iFinance? I'm asking this from the perspective of VC, NBFC, MFIs translating into small finance bank, SFBs into universal banks. We saw a lot of conversions happen just last year. Some might come in the months to come. What's the larger vision for iFinance here?
Yeah, I think we have kept our approach quite simple. Our focus is on micro enterprises, and we will stay with that customer segment because there's so much more to be done. And there's such a large target market that we are fortunate that we have figured out how to underwrite this customer well and to also collect from this customer well. So we'll stay focused on that. And if we do this well, then the form does not matter. Whether we are an NBFC or a small finance bank, etc., time will guide us. I think uh, I think ultimately for the forms of governance, let pools contest. Whatever is best governed is the best. We have to be the best in our area. And if we do that, I'm sure that wonderful opportunities will emerge and we will be there to make use of them.
Sure. So thank you so much for speaking with us and talking about the IPO and the whole landscape in general. Thank you for watching etbfsi.com.